A newcomer who arrives in Canada with $150,000 sitting in an overseas account and quietly forgets to report, it can be hit with more than $7,500 in penalties and interest. That is not from unpaid tax, it is from paperwork they never knew existed. The moment you become a Canadian tax resident, the rules change, and the CRA already shares data with dozens of countries. Here are the 6 mistakes that trigger that bill. I read the fine print so you don't have to. In a realistic 6-year model, $120,000 held abroad earning 3%, the total CRA bill in back taxes and penalties reaches $23,600 according to CRA rules in Fasken's tax bulletin. And that is the conservative version before interest is even added. If gross negligence is found, it climbs closer to $30,000. The first mistake is believing your foreign savings only matter once you actually transfer the money into Canada. It feels completely logical. That money was earned before you arrived. It lives in a foreign account, and it never touches a Canadian bank. But Canadian tax residency doesn't work on where the money sits. It works on where you live. The real cost. Once you're a Canadian resident, the CRA requires you to report all worldwide income every year, converted to Canadian dollars. In our example, 3 years of unreported foreign interest, $10,800, creates about $3,240 in back tax at a 30% rate, plus interest according to CRA guidance. The fix is simple. Report every dollar of foreign income from day 1 of residency. The second mistake is never filing Form T1135, the Foreign Income Verification Statement. There's no letter, no slip, no reminder from anyone. The obligation just switches on the moment your foreign assets cross a line, and most newcomers have never even heard the form's name until the CRA raises it. Here's what it costs. If the cost of your specified foreign property tops $100,000 at any time in the year, T1135 becomes mandatory, and the basic late filing penalty is $25 a day, capped at $2,500 per year according to CRA. Miss it for 3 years and that alone is $7,500 even if you owe almost no tax. The fix. If your foreign property crosses $100,000, file T1135 with your return every year. The third mistake is assuming your account is too small or too boring to matter. People picture reporting rules aimed at millionaires with offshore trusts, not an ordinary savings balance they had before moving. But the T1135 threshold is based on the cost of your property, not on how much income it earns or how fancy it looks. The cost of that assumption is real. The T1135 threshold is $100,000 of cost. A plain deposit account counts just as much as a stock portfolio. And the $2,500 annual penalty applies no matter how tiny the income, according to CRA. A quiet savings account can carry the same penalty as an aggressive investment fund. The fix is to add up the Canadian dollar cost of every foreign asset each year, because the trigger is total value, not income. The fourth mistake is staying silent because you're scared of double taxation. Many newcomers reason that their home country already taxed this money, so reporting it in Canada just means paying twice on the same dollars. That fear is understandable, but it leads people to hide income that Canada actually lets you offset. Here's the irony. Canada offers a foreign tax credit on Form T1135, built precisely to stop the same income being taxed twice, according to CRA. By hiding the income, you throw away that credit and hand yourself penalties on top. The worst of both worlds. If this is useful, subscribe. The next breakdown is already on the way. The fix. Report the foreign income, then claim the credit for tax you already paid overseas. Before I get to the last mistake, the most counterintuitive one, the one you're probably making right now, here's the fifth. People assume the CRA can only reach back 3 years, so any old omission eventually goes stale and vanishes. For most tax matters, that's roughly true, but foreign income is treated differently, and that changes everything about your exposure. The cost of that assumption, when foreign property income is unreported and T1135 was missed, late or wrong, the CRA can extend its reassessment window from 3 years to 6, according to Fasken's tax bulletin. On top of that, if it finds gross negligence, it can add a penalty of up to 50% of the understated tax. The fix is to assume 6 years are on the table and clean up past gaps before the CRA reaches you. And here's the sixth mistake, the one almost everyone makes without realizing it. It's simply waiting. People hope the account stays hidden, that international data sharing won't reach it, that silence is safer than speaking up. But silence throws away your most powerful tool, and once the CRA contacts you first, that tool is gone. The cost of waiting is brutal. After more than 24 months of gross negligence non-filing, the CRA can add a penalty of 5% of the foreign property's value, $6,000 on a $120,000 account, stacked on top of everything else, according to CRA. But the Voluntary Disclosures Program can waive or reduce those penalties if you come forward before they call. The fix is to disclose first, because doing it yourself is always cheaper than being caught. If you've been in Canada a few years with money still sitting abroad, check your last 6 returns and your T1135 obligations this week, not after a letter arrives. Next, I'm covering how the CRA actually uses international data sharing to find hidden foreign accounts and what tips them off first. If you want to catch that one, subscribe so you don't miss it.